Good morning, everybody. I'm going to be giving everyone a few moments to log on and then we'll get started. Thank you for being here today. Good morning, everyone. Thank you for joining us. For this session, Summit is proud to partner with BKD. We are excited to have you on this call with us today in view of the current political environment that we are in and the uncertainty surrounding the ultimate outcome of the Biden tax bill. We want to get out in front by sharing the proposed legislation with you all today. Our plans are to host a part 2 to this series once we know the official changes that will be made as a result of new legislation. We do have a Q&A feature available today, so you can submit questions through that option. If there's time at the end of this session today, those questions will get addressed. You can also submit any questions to us via email at marketing@yoursummit.com, and I will display that email address again near the end of our session today. So let's get started. Our first guest is Damian Martin. Damian provides tax compliance, consulting, and planning services to individuals, families, and fiduciaries, and provides proactive succession planning for high net worth individuals and their family-owned businesses as the East Region leader of BKD National Private Client Services Group. Damian is a member of the American Institute of CPAs, where he currently serves on the Tax Profession Strategic Advisory Group, and Illinois CPA Society, where he has served on the Estate, Gift, and Trust committees. Our next guest is Steve Holden. Steve has more than 33 years of public accounting experience concentrated in the retail, manufacturing, and energy industries. He provides tax research, consulting, planning, and compliance services to individuals and families, as well as public and privately held companies. He is a member of the American Institute of CPAs and Oklahoma Society of CPAs. He speaks frequently for various organizations on tax issues related to new laws and planning considerations. Our next guest is Bo Cotton. This is Bo's 35th year of service in the insurance industry, a specialist in business and estate tax for privately held businesses, and former CEO of the Resource Group, a firm that could implement the services of banks, brokers, and benefits specialists. Bo now serves as the VP of Advanced Planning for Summit. And our last guest is Jill Young. With more than 2 decades on the Summit leadership team, Jill Young serves as Summit's general counsel, building and developing relationships with clients, attorneys, CPAs, banks, insurance agencies, nonprofits, and companies. She serves on many professional and community boards, including Mental Health Association and Oklahoma Center for Community and Justice. Now I will hand it off to Steve to start our session today.
Welcome, everybody. Thank you, Riley. As Riley said, BKD and Summit have joined together to present this material today. We've joined together on several different occasions, both for webinars and also seminars to present relevant topics that will help you in your businesses and your personal planning. We have mutual clients in all types of industries and enjoy working together in serving both of our client bases. Today, the topic, we had difficulty figuring out exactly when to present this because the changes are still going on. We don't really know yet what the final tax laws are going to look like. As Riley said earlier, this is part 1, and after the tax laws are finalized, we are planning for part 2, where we will go over what has actually passed and discuss, the actual tax law changes, not the proposed tax law changes. With that, I'm going to hand it over to Damian and let him go through what's out there, where we are today, and what some of the proposals look like. Damian?
All right. Well, thanks, Steve. And good morning, everyone. Glad to be here with you, at least virtually today. So we've got a number of slides to go through, and we're gonna go from kind of at a high level, because I think the most important thing, and you're going to hear me kind of leave a couple takeaways as we go through, but the first is to have a sense for what's out there and maybe what the chances are of it becoming law, and maybe what the pathways are for it to become law. And so that's really how we're going to kind of lay things out. And as we kind of jump in the materials here on our first slide here, we've got I think that the place to start is kind of where we have, where we've been and maybe where we're going from a timing perspective. I think there's been a lot of conversations in the last, really since the election, and in particularly since January, with the Biden administration coming into control, that we would see maybe some tax changes. The president had campaigned on them, so we knew that was likely. And we also saw that we have, similar to the ingredients that we had for 2017 tax reform, that led to the Tax Cuts and Jobs Act that we saw, where we have the same party in control. Although in this case, it's a very, very narrow margin. Really, it's the thinnest margin that you can have of control in the Senate. It's 50-50 split with the tie-breaking vote from Vice President Kamala Harris. And in the House, really, there's only a 3-seat or a 3-vote margin that the Speaker of the House, Nancy Pelosi, is dealing with. So this is becoming very, very difficult from a political standpoint. So again, I think it's important to know what's in there, because I think there's a notion, this is my sense, what I'm hearing, that there's a lot of work that's been done, and there's a lot of momentum to try to get this done. And so I think we may see something. The likelihood is that those come with some revenue raisers or some tax increases. And so that's why we want to know, what's happened, and what's out there so far, and then knowing where it might go. So with that in mind, I guess, our next slide, Riley, is this timeline. We'll kind of keep moving past that. I guess the one band there you go. We'll keep moving past that, because I think this is good reference material for you. The momentum and the headwinds, again, kind of talked it through. I think the thing that maybe gets a little confusing is they're using this process that I'll call a 2-track process. There's the infrastructure piece of the Build Back Better agenda, which was done with a bipartisan approach, I guess we'll say, and it actually passed in the Senate, but it hasn't gone anywhere in the House yet. There was a deal sort of get it done by September 27th. I have to say that if I was going to guess, I'll say that that's probably not going to happen by September 27th. And the reason for that being that there's actually probably the normal order of business in Congress. They've got to take care of the budget for the next year. Otherwise they get a shutdown effectively. And they have to take care of the debt ceiling so that things can continue to move on. Both of those have to be done. The approach that House Democrats are taking right now is not one that is probably seen to be successful. So we may be looking at a government shutdown when we get to October 1, and also be staring at the debt limit probably in the second half of October. And so while these, like I said, there's a lot of momentum to try to get some of these changes we're going to talk about into law, the reality is there's a number of things going on. I think it's going to be, I was calling for a busy September. It certainly has been. I think it's going to be a busy, even perhaps busier October. And that might be when we would see so path 1 of this 2-track is the kind of more hard infrastructure, the bipartisan piece. And then the larger piece is budget resolution and reconciliation approach, which has been approved and they're working on. And that's what happened last week. So if you saw a lot of the headlines around what's going on last week, we're about to get into the reason why. So as we kind of move forward, let's take a look at some of these individual provisions that we're looking at. And this isn't everything. This is high level. There's a whole lot more in there. And if I was going to give you, again, another talking point, the first one is, be aware of what's out there. The second point is, really have to look at your specific situation, because it really depends on what factors you have at play. I like to look at it sort of like you have levers that you're going to pull, but you kind of need to know what you're dealing with before you start pulling levers. So real quick on this bipartisan infrastructure deal.
Excuse me, Damien.
Yeah, absolutely.
Is that 550 billion or is that 550? Is that million correct?
That is a billion. That's a good point. That's something there. It is 550 billion. The price tag that's been thrown around is 1.2 trillion, but really it's only 550 billion with a B. Great point, Bo, of new spending. And the big point it's the one item that's bolded is October 1 would be the end of the employee retention credit. If you're not aware of that, I'd point you out to, and actually I'll probably mention this at this point in time as well, that I also host a podcast for BKD, which I always try to tell everyone, it's every bit as exciting as you would hope a podcast about taxes would be. But seriously, we do try to make it interesting and informative. And we've covered a lot on the employee retention credit, but that would end a quarter early as a way to pay for this, among other things. The other thing I'll mention is our most recent episode of this podcast, episode 129, talks a lot more about where we might be going. I'll cut to the chase and tell you my thought is that this budget reconciliation, we might see, end of October going into November in terms of timing of some of the changes. So let's get into those. On our next slide, we'll start with the corporate change. Right now, and this is how all these slides are going to be laid out. And Riley, correct me if I'm wrong, but we'll get the materials shared with everybody so you have them as a reference as well. But
yes, for sure.
Perfect. All right. So the way we have them laid out is where we are currently, what the Green Book proposal is, which is what the Biden administration is based off of the Biden administration's, I guess, wish list. And this Green Book, as it's so called, came out from Treasury back in May and talked a little bit more about the proposals. And then the final column off to the right there is Ways and Means. So this is what was introduced by House Democrats last Monday. And then it went through the Ways and Means Committee and they voted to advance it without any amendments. So the 881 pages of kind of revenue raising, tax changes primarily, they kind of went through on the House side unchanged. So looking at the corporate rate, what we had after the TCJA or that 2017 tax reform was a flat 21% rate. The Biden administration was originally saying, well, we'd like to see a flat 28% rate. And as many were calling, and so this isn't entirely surprising to me that we saw maybe somewhere in the middle with a 26.5% top rate. But that's for C corporations with incomes over 5 million. So I'll say this was a little bit of a surprise to me because we actually would go back to a graduated rate system so these are C corporations, right? If you have your business structured as a C corporation. So you'd have 18% at the bottom, up to 26.5% at the top for the corporate rate. Now, most of these changes we're going to talk about if they were enacted. So that's the big if, right? That's if they get it through the process, and they're likely subject to change as we go through it and they navigate it because of the need to get it through the Senate primarily. And most of these changes would be prospective in enactment date. So it would be 1/1/22 really that would start to go into effect. Next slide, we talk about the individual change. This also wasn't a surprise because I'd say it really was in line with what the president was talking about, saying, well, let's take that tax rate back up to 39.6% for ordinary income. That's what it was before the 2017 tax cuts. The difference between what we saw last week and what they were originally discussing is that top rate would start to apply at a lower threshold. So basically more people would be subject to this 39.6%. As you can see, it's incomes for individuals filing separate of 400,000 versus it would have been 452,000 under the Green Book proposal. So we'll kind of see where that lands. The next slide, we talk about something that's entirely new that would basically raise this new 3% surtax on high income taxpayers, which are defined as those with, it's an adjusted gross income number, but basically income before deductions like charitable contributions and the like of 5 million or more. So that would basically be another layer that would go on top of that 39.6% as the top individual rate. It also apply on top of capital gains rates, which we'll get to in a minute. But this 3% would be prospective in nature. So it'd be 1/1/22 that would go into effect.
Damien, let me jump in real quick and just to ask a question. So if you have a pass-through entity like a partnership or an S corporation, then these tax rates are really burdensome for those business owners because these are not the wages they're living off of, but this is the business income that's being taxed at these higher rates.
That's absolutely right. And we'll have a slide here, Steve. I'm glad you made that point. The slide at the kind of end where we'll land, I'll show you kind of what it does to the rates and the choice of entity. And it absolutely does. And so that's really what I'm focusing on. So if you have a business, a pass through, like you said there, Steve, we'll say you're an S corporation. Right now, the top rate would be is 37% on that ordinary income. But you probably also get, depending on the business that you're in, the line of business that you're in, and if it's a trade or business, you get a 20% deduction on that. So it really means that the top rate you're paying is 29.6%. Well, we've already talked about how the rate would go from 37 up to 39.6. if your income's over 5 million, you'd add 3% to that. And because you're an S corporation, that actually leads to the next slide here, where you'd get impacted. Right now, S corporations don't pay self-employment tax essentially on that income that's kept over. So I'm gonna kind of round the corner here and basically say that what they would be proposing to do is there's the net investment income tax, which is something that came around a number of years ago. It's a 3.8% tax that you add on top of certain income. Active businesses, you don't generally, but under this proposal, it would. So going back to your number here, Steve, right? So we were at 29.6. Well, now it's 37% or 39.6 instead of 37, adding 3%, and you'd add another 3.8% on top of that. So your top rate on that pass-through income really goes up in terms of things. And we'll get to this a little bit later, but there's that 20% deduction. They're talking about limiting that to a maximum of $400,000 for single individuals or $500,000 married filing jointly. So that would mean that, that impact of getting your rate down to 29.6%, really you start to lose the benefit there to a certain degree. So it could mean, that top rate goes up pretty significantly, particularly for that pass-through income, to your point, Steve. And then I guess the next big thing I've been getting lots of questions on is this next slide is the capital gains rate. This is one that since the beginning of the year, I think this has probably been the most frequent question I get is, well, what's going on with capital gains rates? And what we saw originally was, where we are currently, I should say, is we have a top rate of 20%. Again, you have to add maybe that net investment income tax. So maybe it's 23.8% if that applies. The Green Book, so the President Biden, his proposal was, we'll take it up to the top ordinary rate, which is proposed at 39.6% for those with incomes over $1 million. Well, the Ways and Means proposal actually was more favorable in terms of the rate, which is 25%. And also that it would, but I guess so it's more favorable there, but less favorable in the fact of who would apply to, because it would start to apply to those with basically $400,000 of income or more. So a lower rate, but kick in a little bit earlier. And that would be, it's as of the date of the release of the text, which was last Monday. So anything that happened, unless you had a binding sale agreement in place already after September 13th. So if you're trying to plan a sale transaction, maybe that already happened. If they don't make any changes and this goes into law. Although I would tell you though, if you're looking at a larger gain transaction, it still may be advantageous to do that before the end of the year. Again, if all this happens as it's currently, being discussed. And the reason is that 3% tax that I mentioned, the surcharge tax that applies after 5 million, that only goes into effect as of January 1st. So we're kind of in this interesting sort of ramp up, I guess, if you'd say, if all this happens, it was 20% 2 weeks ago. Now it's 25%. But then if you get to January, it becomes 28% plus the net investment income tax. So you may be in an incentive to maybe sell, if you're looking at selling a business or doing a transaction, it still may be advantageous to get that closed before the end of the year. And to illustrate that, as we get to these next couple slides, the first, just kind of tease up the situation. And that we said, well, what if, and this is under the Green Book proposal, what if, all that happened, how much more money would you need if you were selling your business let's just assume the business has an enterprise value of $100 million. How much more cash would you need of it from the deal to end up on the same spot if that Green Book proposal, so again, that capital gains rate going up to 39.6%, how much more cash would you need in your pocket? The answer, here's the math, but we'll skip to the next slide and it shows kind of the bottom line here to say that if you're doing a stock sale, you need that purchase price to be 140 million to end up in the same spot as where you were before this was proposed. And if you did an asset deal, you'd need $28.8 million more. So, pretty sizable amount of cash. Again, the rate that's in the Ways and Means provision or proposal is less than that, but it just kind of shows you the impact that this change could have. And it can have a material impact on deals and exit strategies and so forth. So been having a lot of conversations around it. Here's what I would say the takeaway is for the capital gains and that side of planning is modeling. We don't know what we don't know, and we'll talk more about that. And Bo, I know we'll talk some about that as well. But the one thing you can do is you can plan for what we do think are possibilities. And I think that's the way to do it. So kind of like that previous slide showed, the modeling, that's the kind of thing you want to be doing with your advisor right now, and getting your whole team, your estate planning attorney. We haven't talked about that quite yet, but that's a big piece. All of your advisors involved in this conversation. Let's go through a few more of these things, then I'll turn it over to you, Bo, to kind of to dig in a little bit. So as we flipped over to that kind of that estate conversation, there is this concept known as the step up in basis, which is really as a technical tax guy, I always kind of say, oh, it's not really a step up. It can be a step down, because it's basically saying, well, whatever the assets are valued on as the date of your death, they get basically adjusted to fair market value as of that date. And so that's why sometimes it can be a step down, but generally it's a step up. And so right now we get that fair market value bump, we'll call it, at date of death. The Green Book, so the President Biden proposal, was to take it and say, well, we're not going to do that anymore. And there's a whole lot more to how that provision was structured, and say, well, we'll give everybody $1 million to be able to allocate. And there's certain carve outs for farms and closely held businesses. But generally, you wouldn't get the step up. In fact, you'd actually get a recognition event. It would be as if you sold your assets. So if you had your stock of Apple that you've been holding on to, from day one, that has this huge amount of gain built into it, under current law, you would get a step up in basis to whatever Apple shares are worth as of that date. Under the Biden proposal, you would pay tax on it as if you sold it as of that date. And then the Ways and Means, though, because of the fact that this was not, because of some of the pushback, essentially, they felt they didn't have the votes for it. So they pulled it out of the House Democrats' proposal. So this basis step up, and this recognition event at death, that's off the table right now under what the Ways and Means Committee proposed. And I would be really surprised, honestly, if it came back at this point in time, just because of the fact that it has a lot of opposition to it. And if I was going to give you a talking point takeaway on where I think we're headed here, I think whatever the Senate comes up with, and because that's really where it'll go after it gets out of the House, the Senate Finance Committee will maybe do a markup and propose their version of all this. Whatever the Senate lands on, the House is probably sure to take, because I think it's harder to get through the Senate than it is the House at this point in time. So all that to say, I don't think we're going to see the basis step up come back, but that, again, I can't rule it out. If we get to the next page, this is what they did instead. They basically said the lifetime exemption, everybody gets an amount that they can give away during their life or at death. Right now, it's an inflation adjusted $10 million, or actually 11.7 million in 2021 per person. So a married couple gets just shy of 24 million. Under the Green Book, that they wouldn't change it. Basically, the thought being, well, that $10 million inflation adjusted amount, that reverts back to $5 million inflation adjusted after 2025. So in 2026 anyway, under current law. But the House Ways and Means proposal would basically say, well, we're going to go ahead and do that for those dying after the end of this year. So pull that back earlier. But the big one we'll dig into this probably a bit more later, I think, Bo. But they're making some proposed changes for grantor trusts, which are used very frequently in estate planning. And if you hear any of the kind of the 4-letter alphabet soup of things, if you've heard of grats and idiots and islets and all these things that estate planners like to talk about, there are types of grantor trusts that rely on this provision that this proposal would effectively make no longer effective. There's some grandfathering that would happen to those that were in existence before this thing would go into enactment. But it's important to note that there would be some big changes there. All right, a couple more provisions we'll run through here, and then, like we'll say, we'll kind of land the plane with the overall big picture. Qualified small business stock. This one was a surprise to me. I'll say that the Ways and Means proposal would limit it for those with incomes over 400,000. It wouldn't do away with it, but it would significantly limit it, and that would be effective as of last Monday. On the next slide, we deal with a couple more things that were thrown in here. Was defining what qualified small business stock is. Again, if you want more on it, we have a podcast episode on it. I can direct you to. It's a really great planning technique, and I think it still is, even if they limit it. But it's important to know what is and isn't qualified small business stock. A couple other things I foreshadowed here a bit: the qualified business income deduction, or that 20% deduction. That basically would be curtailed, as I mentioned, limiting the maximum amount of the deduction to either 400,000 or or 500,000, depending on your income. But for trusts and estates, man, it really they get kind of hit hard here, where you're limited to $10,000 for trusts and estates. So that's pretty a low amount. So you effectively lose that deduction amount. Carried interest amounts. Basically, the Ways and Means proposal that was thrown out there is a little more favorable than the Biden administration's proposal, and basically saying that you'd have to hold it for 5 years to get this capital gains treatment. So, all right, 1031 exchanges, those would still be in play under the Ways and Means proposal. So this is if you're doing real estate transactions, basically at this point, those would still be a planning option, at least under the Ways and Means proposal. And then the excess business loss limitation, this is something that it's another layer of loss limiters that come into play. If you're a business owner and you know about losses, there's a lot of hoops you got to jump through to get that benefit of that loss. Basically, they would disallow these losses. They'd allow you to carry it forward, but on a very limited basis. And this actually would be retroactive back to the beginning of this year. So it could have pretty, I'd say, surprising impacts on 2021, if particularly for businesses that maybe aren't performing so well because of the ongoing impact of the pandemic. So, all right, a couple last little things to hit here. First, there's some big impacts on IRAs. I'll leave these points here. We can dig into them maybe a bit later, but basically those with higher value IRAs would be limited. The other proposal that's in there is there, because I've heard this to say, well, what if we just kind of play the audit lottery? They don't seem to be auditing that much. Well, maybe they would start auditing, they being the IRS, after this legislation, because there would be an infusion of additional funds to improve a tax administration on high net worth and high income taxpayers. And the last thing I'll mention is kind of what wasn't in the Ways and Means proposal. And that's kind of this next slide here, which there's a few things that were thrown out there from the Biden administration, really second bullet points. But the big one that I'd say that, and I would expect that we'll see something, is this cap on itemized deductions, that's known as a SALT cap for state and local tax deductions. Basically, it was limited to $10,000 under 2017 tax reform. And there's been a lot of thought to try to get that removed. And so maybe we'll see that when we get over to the Senate. But all right, so let's land the plane here before I turn it back over to you, Steve, to tee it up to Bo. Couple last slides. So what are some strategies and considerations? Really, here's the summary by numbers I was mentioning. So your top ordinary income tax rate for individuals will go up to 46.4%. Top capital gains rate, and again, so that top rate right now is more like 40%. Top capital gains rate, which is right now it's 23.8%, it would go up to 31.8%. And corps would go from 21% up to 26.5%. So clearly tax rate increases all around. Next slide kind of breaks it down a little bit more if you're planning choice of entity. And again, I would encourage, my takeaway here is have a conversation and do the modeling if you're looking at business, changing maybe how you're structured from a business tax rate perspective. The math gets complicated and the factors become complicated for sure, but at least comparing, should I be a C corporation? Should I be a pass through? Do I get that 20% deduction you mentioned earlier? Those are all questions that come into play. And finally, I want to leave you with 3 things that you can do, right? Like I said, what are the takeaways? Review your current situations. You kind of have to know where you are, then work to do some modeling around maybe some of the possible outcomes, maybe some of the things we might see, and what are some strategies? And I've listed a couple bullet points of things to think about. And then the third thing that I think is most important is maintaining your flexibility. Keeping all the options open, especially around estate planning. We'll talk more about that. Get the trusts in place, because if you don't have them in place, you can't do anything with them. So you need the most flexibility you can to move forward. So I know that was a lot to kind of rifle through. There's a lot in there. Like I said, 881 pages to kind of go through. But those are the talking points I think you need to know right now to be informed. So Steve, I'll kick it back over to you so we can keep the conversation going.
Okay, well, thank you, Damian. Certainly that is a lot to cover, and these are the high points. There's a lot of detail in that is out there that we still have to go through, and of course we still don't know what all that detail is. One thing that's not on your slide, and certainly not anything that I heard, was any type of simplification. They've just continued to add layers of complexity and layers and layers of new calculations that we have to go through as we do the tax returns, both at the federal and state level for individuals and your companies. So just hang on with us. So next up, we're going to hear from Bo. Bo has been with Summit for several years and has extensive backgrounds in helping companies and individuals work in these challenging times and just address what do you need to do whenever the environment is unsure and uncertain and changing. So with that, Bo, I hand it over to you.
Well, thank you, Steve. I do appreciate it. Good morning. I'm Bo Cotton with Summit Financial Group. I'm Vice President of Advanced Planning, whatever that means. But part of it falls into trying to anticipate what kind of changes as a company or as a process we may have to present based on the new rules, laws, where the government's heading and going. I really appreciated Damien's presentation. It was pretty straightforward and extremely informative and covered a lot of ground. I guess so, to keep my part relatively short is, and the reason I'm even on here, because you've got smart guys at BKD. Of course, you probably have a smart attorney on your own if you're an individual client, or if you're one of our clients, they certainly typically have their own counsel. And the reason that I'm sitting here is because it takes three, in my opinion. The attorney can draft the structure of the process, and CPAs keep score as we go along to make sure that what we're doing is working. But at the end of the day, regardless of what these numbers end up being, I mean, today they're 26, or are they going to be 25 or 31, or is it going to be, with all these things in the wind, and the whole purview of this focus was, how do we create certainty in uncertain times? And I would say then that we can use what we do know between now and the end of the year to the advantage that I would suggest. And part of this, the first thing I would say is, as Damien mentioned, and I spoke with him specifically prior to having this discussion, so that I'd know I wasn't talking off topic, for having your clients take a look at using their non-qualified gifting exemptions today, even if it's in their corporate stock, because the reality is they'll take all the growth of that stock out of the estate, and the grantors can still receive the income through the HIMSS provisions. So I think, when we start looking at the one thing that the CPAs can do is they can count what's owed and how to avoid them. And the attorneys provide the structure and the basis for what we're going to do. And what my role is I provide the cash that comes in exactly when it's needed to make sure these things come true. When you hear the term business succession planning, we all hear it. To me, it's about how many jobs can I save? Small business today is under great attack, especially particularly ones that are in the manufacturing, heavy industry, road building, construction, where they've got tons of overhead. And I've made a living the last 15 years with no tax changes, strictly by talking to clients about how are they going to get to banks to refinance their debt or their normal creditors, knowing that the IRS is likely to step in a few months and can jump over any credit. So how do we protect the banks? If they do that, the businesses are gone. So I just would say that, as far as roles go, it really takes, the attorney, the CPA, and the guy in my position to help provide the funding, and hopefully some of the planning and at least getting an idea of what you want, so we can cut your time down and spending time with multiple advisors. Most of these decisions that are made are emotional. They're not legal. Any legal decisions, of course, we leave to the lawyers, and even specific tax advice we're going to leave to the CPAs. We can talk to our clients about strategies and then help them set those meetings, which is what we do. I heard Damien give one really nice word. I heard him say it several times towards the end. And to keep us not so far off timing, I'll make sure I get to this part pretty quick. Is I heard Damien use that word review towards the end. And I don't know that there could be a better word for today. What little bit of certainty we have out there, we should take. We should just absolutely take it. Meaning, if we can move shares into an island, we should do it. But the other one that we should take is if there's a need for liquidity. And if you think that if you start thinking about how the dominoes fall, if we enact some of this legislation, the next domino to fall is going to be the reaction of the commercial banks, because they're not going to allow themselves to fall at the bottom of the chain and not get paid on commercial loans. And so I've kind of got an idea that serves our industry, and something as clients you all might want to consider, is when you take a look at making sure your estate at least is in a position to cover its traditional debt, where it has time to work out a program with the service if the liquidity need exceeds what cash they have on hand. At least if you don't have traditional loans, they could put a lien on your shares, your assets, and it wouldn't close you down unless bonding was an issue. But I think there's several areas that the life insurance industry is going to be able to help create industry moving forward. Is I think bonding, life insurance is going to become a much larger part of bonding. When they start looking at the cost of completing jobs, I think the second area, commercial loans, probably 50 to 40% of my business over the last 5 years has come from banks requiring it. I think that's only going to increase under the new circumstances. And the other part is, we really need to take a look at, if you've got a small business, yes, you've got 3 obstacles to overcome. You've got a capital gains and estate tax, and then a succession and traditional creditor role to fill. I would say if we can get one off the plate before we go into the estate portion, it would certainly be doing your heirs a favor, because I've made it my goal to try and save as many small businesses as we can. I think when they look at those capital gains taxes, they look at the stock market and realize and see all the liquidity, that's there. But in the privately held market, as we all know, we get into agriculture, manufacturing, fabrication, bulldozing, drilling rig company, truck hauling. I mean, you name it. If it takes iron, they borrow money. And keeping them in a position to keep their creditors happy is a huge deal, because usually one of the main covenants on a line of credit is they cannot take on any more additional debt without the bank's approval. Well, who could approve a $10 or $20 million tax hit to your balance sheet that you're paying off over time? I don't know. But I just want you to know that, as far as who's the impetus and helping get this started, we would love to, if any business ever comes our way, but we certainly going to steer you to the BKD role in the event that there's tax issues that need to be dealt with. Our job is to kind of help you find out what the ability is or what your needs may be from a liquidity side, kind of give you an overview of what kind of changes you may want to consider, and help you make some of those decisions prior to going to the attorney or CPA to make the whole process much simpler. So again, my name's Bo Cotton. Very fortunate to be with Summit Financial. I was here 15 years early in my career and had my own firm for many years, and finally got the opportunity to come back and work with Dale, and excited about it. So I think anybody here at Summit can do you some help. We certainly would love to work with you. So Jill, I'm passing it to you.
Thank you, Bo. So now we're going to start the Q&A portion of the webinar, and I will be pitching some questions to Damian and Bo in this last 20 minutes. As Riley mentioned earlier, if you all on the call have any questions, we're happy to field those as well. So Steve, you might watch the chat for that as well. So the first question is, what is the likelihood of the capital gains tax rate increasing, and is the increase retroactive? Damon, do you want to start on that one, and then we'll move forward?
For sure. Thanks, Jill. Yeah. And that is like the question. And I think I maybe even mentioned that in passing, that I feel like we've been getting, especially since I don't think I actually mentioned this, but if you go through the timeline, the Biden administration had introduced the thought of increasing the capital gains rate formally back at the end of April. And so there was a lot of conversation around, well, the capital gains rate could go back retroactively to the end of April. I would tell you that I think that won't happen. Again, nothing's of certainty, but that won't happen. If you ask me whether I think it's going up, I think there's definitely upward pressure. I think the rate that they land on, that 25%, is around kind of what we've heard that those who do vote for it would be comfortable with. So if I had to kind of read the tea leaves, I'd say that I think the thought is the rate's going up, and I think 25%, maybe 25 to 28% is sort of the rate that maybe it would head to. In terms of retroactive, that's a tricky one, because there's kind of two trains of thought of that. One is they can do it. They can make it retroactive back to January 1st if they wanted to. Technically, practically, that's incredibly politically unpopular. And so I think that would be, that would be very challenging. We've already heard senators and even congressmen and women that are pushing back on that notion. Now, September 13th is probably a little bit more palatable. So I think there is a good chance that actually might be the case if it goes through as it is, that September 13th introduction date would stick. Because the other camp says, well, if you do it as a 1-1 and we can see this train heading down the tracks, well, then it's going to cause a sell off in the market, because everyone's going to try to sell things off before this new rate's going to go into effect. And so maybe the way to avoid that is to say, well, we already drew the line in the sand. It's happening anything after September 13th. So that one's a little trickier. I think I'm leaning probably towards more that's where it would land. Again, just my personal crystal ball here. But I think rates are going up, and there's a good chance that it could be as effective as of September 13th. I don't know, Bo or Steve, anything you kind of add from your perspectives? Okay.
Okay, the next question that I've got here is, are you seeing anyone accelerate capital gains where they can in anticipation of the increased rates?
Yeah, that's a good question. I'm sure Steve and Bo, you've probably seen this as well, but absolutely I have. And there's been a lot of, I'll say, M&A type activity with those maybe looking to sell, maybe exit. And now's the kind of a good time. Maybe the pandemic certainly wasn't what anybody was hoping for in value perspective and so forth, but maybe value did all right. And after that process, they're looking at the business and saying, gosh, I was planning on maybe exiting in 5 years. I don't know if I'm going to get, if I got another 5 years in me after everything going on. Now's a good time. I'm happy with the multiple on the sale. I'm going to do it. So then there's this pressure to try to get it done. The fact that like I said, the rate increase on the capital gain side may have already been, that die may have already been cast, I guess is what I'm trying to say. That may dampen it a bit, but if you're looking at a large enough gain, it still would be, under the House and Ways Means proposal, cheaper to do it today than it would be on January 1. So the answer, that's a long way of telling you, yeah, Jill, I'm seeing a lot of that.
So Damian, with that September 13th date out there, does that mean that planning's off, or do we need to go ahead and move forward? And because the laws are not finalized yet, we don't know that's a firm date.
I agree 100%, Steve. Yeah, I think you still move forward. I think it could end up having impact on prices, potentially, if it looks more likely that September 13th date does hold. And I think that's part of the negotiation and definitely, part of the conversation at this point in time. But I would say, keep that moving. And if there's interest in doing it, at this point in time, I think it's going to be a very, very end of the year, busy end of the year for all of the, if you want to call it your kitchen cabinet of advisors, right? Your insurance advisor, your CPA, your attorney, it's going to be a busy end of the year. And so, if you're contemplating it, I think it's still on, and you keep on trying to go down that track and really try to, and then in my mind, then try to target by the end of the year to get that done, if that's what you're looking for.
May I break in just for a moment on that? Because I have a thought on what you just.
Absolutely.
Yeah, I agree totally. I really appreciated the succinct way you kind of put that together. It's done well. My thought is this: just as you said, that there's just so much unknown or uncertainty at this point, what I'd like to say to the audience out there is that liquidity is going to be key. I don't see how anybody could argue it that's taking a look at this. And if there are some small businesses or family businesses or privately held that are going to be exempt, it sure would be nice to know, because the ones that the capital gains are going to hit, along with the potential estate tax hit, where you've got a new liquidity event, in other words, is going to put a lot of pressure on traditional creditors. My whole gift last 15 years has been just under current law, how are you going to refinance the corporate debt? That's not, and it's not a relationship that automatically transfers. If Dale Young at Summit walks into a bank, they throw money at him. If I walk into a bank, they barely let me in. And it just kind of, that's going to be that process of, I tell clients daily that you've got to leave your heirs more bankable when you're gone than you are while you're here. Or refinancing this debt could be just a whole moot point. One of the ideas I'm having working with banking today is saying, hey, you better package these in with your commercial loans. And I don't mean credit life, I mean real life, where we could actually have it owned by a trust and try and fix values doing buy sells between the irrevocable trust and the living trust. As long as we stay within fair market value range, it's almost impossible for the service to throw it out. I'm not trying to avoid or evade taxes. I'm trying to say that let's limit what we're going to have to pay, and let's at least be aware of how much liquidity we're going to need. Trying, once we sort all this out, figure out how much liquidity are we going to need. And my last point I just wanted to touch on and appreciate it was that, you and I spoke just prior to everybody else coming on board, and the income tax and the state tax side are a little bit, obviously they're on separate ends of the spectrum as far as service is concerned. That you mentioned that the gifting programs would probably be a smart thing to consider between now and at least till it's done or end of the year, at least until we know different or end of year. Is that accurate? Probably.
I would say, and this is the way I was phrasing it, to a conversation I was having just yesterday. Well, I've been probably using this line a little bit more frequently, is run, don't walk to having these conversations, because, it may get pulled, the provisions, particularly with using these, spousal lifetime access trusts or intentionally defective grantor trusts or whatever the variety you have. This provision would be effective as of the date that it was the bill was enacted. So whenever President Biden would sign it, so that could potentially come as soon as next month. Again, I think that just seeing the path forward and all the other challenges, maybe that slips into November. But you're still probably looking at in pretty short order here, where some of the very powerful estate planning techniques would be off the table effectively. And actually, and then I see there's even a question that coming around the interplay with the insurance and impacting, kind of the tax, the personal and the business. I mean, that I think it plays a very big role in looking at the role of insurance in the overall portfolio, and as in terms of planning, even going forward, I think is very significant.
Hey guys, we do have a question in the chat that speaks to this. Bo, you may want to hit on this. How does insurance impact this year's personal and business 2021 situations versus 2022? So can you just hit on that, Bo, and elaborate?
You talk about what kind of insurance?
And is it too late to react to make it impact 2021? I would say the life insurance.
No, because we're going to use that as part of the gifting program inside an irrevocable trust. I mean, thank you. That's a perfect lead into where I really wanted to go after hearing Steve, was that, I think that if we can move company shares in for people that are comfortable with it, and shares are in husband's name and they're good, happy with their wives, make the wives the trustee, we get it out of the estate to the extent that we can, make the kids beneficiary. Income still comes back to mom and dad. But one thing on the life insurance side that I would really challenge all of you to think about is that a lot of these companies today have traditional key man insurance where the company pays for it and the company's the beneficiary. One of my concerns is key man insurance now is going to inflate the value of the company. And a great deal of key man coverage is actually on the owner of the business. And so that would be at the time of transfer and the time that this tax that we were talking about would kick in. So I'm suggesting that, hey, why would not you have insurable interest as an owner of the business? Why wouldn't you own that policy personally? And as the company needs capital, you inject it into the business to get a stepped up basis, as opposed to automatically inflating the business by the amount of the key man, and then ultimately having it taxed at a 40% rate as it goes down to the next generation. You know, the whole idea is to have income tax free. And there's a great way to do it, because we can not only avoid the insurance from being taxable, we can increase that stepped up basis, which is going to reduce the capital gains of transfer. What do you think of that? What do you think about that, Damien? I mean, is that it's pretty palatable? I mean, that's why I'm telling any of my clients that have corporate owned life insurance that their corporation's paying for, particularly on the owners, that now is the time to really kind of revisit that. Or if you have it even on your key and people that you would have substantial loss in the event they were gone, that why not own it personally? It's easy to inject money into the company. It's a lot harder to get it out. And so
I think, Bo, I think what you're saying, and a couple of questions that have popped up, I think the main thing that's a takeaway is that if you have a transaction that you're working on or that you're planning, or if you do have estate questions, you need to be talking to your advisors and lining it out and coming up with those discussions. You know, here during the time that the laws are still in a state of flux, the effective dates may or may not have happened yet, but we need to be talking to you so that we can plan it through and see what the different options are.
That's a great point. Yeah, we are.
One last point I think it's important, Jill, for us to make on the insurance side, because you know, they've mentioned sense of urgency due to the calendar, you know, which we all understand that. But there's also a second sense of urgency in talking to our side of the industry, is that the impact on COVID. Imagine, you know, nobody thinks about that word life insurance and COVID or pandemic. They're not very good in the same sentence. And so it created massive changes to our industry last year. The industry's reaction initially was basically just to shut down everybody over 60 or over. You know, since I've been in the business in 1986, they accepted cases up to 80-year-old. And then all of a sudden, companies were saying, we're not going to look at applications unless they're 60. And they also, as you all know about retention on our more sophisticated people that understand banks, lending, that kind of thing, most of the banks and insurance companies have cut their own internal capacity or lending or down by 70%. So they're having to get outside participation, either through participating banks or reinsurance companies on the insurance side, which means they have a little less wiggle room to make quality offers. I just would challenge you not only get to the doors yesterday due to Uncle Sam being on our heels, but if this D variant or some other variant manages to cross over the border and we have a significant breakout again, to the point where these carriers start shutting doors again, I'm not sure they're going to have the ability, how many are going to reopen, or if they do, what kind of products we're going to have to offer. You know, today we can still offer products that can cover them through the entire part of their estate.
Bo, thank you for that. We do have one other quick question in the chat here. Does an LOI signed before 9/13 qualify?
As long as it's binding, then yes, it can be completed after 9/13, but it can't be had to be binding, and you can't have altered it. That is the way they've worded it in the legislative text.
Okay. Any other comments, Bo, that you would have? We've got about 5 minutes here, and or any other questions in the chat? Any questions or any comments from our panelists in terms of planning for the end of the year that you want to add, and the gifting or?
I just say one thing, Jill, follow the advice you gave right there. Everybody ought to take the time between now and the next 30 days, because you go beyond 30 days, your ability to make any changes is going to shrink. You know, we've got maybe a 30-day window here, but we still have the time that if there's something you want to take advantage of on any of the ideas that either BKD came up with, or maybe some of the potential ideas I discussed, hey, you know, then I would just say, as Damian mentioned early on, run to the aisles, don't walk. It's going to be like a toilet paper shortage back a year ago. You're going to see a lot of empty aisles because the carriers will get backlogged. They're already running on thin margins. So trying to get things pushed out as fast is harder. Underwriting's increased. And I just would say it's got to be tough on your end as well. So I know it's been a tough year and a half for all of us, but I want to say I'm extremely excited about my affiliation with Summit and appreciate you guys at BKD. That was an excellent presentation, Damian. I really appreciate it.
No, I appreciate that. And I think what I really like about this conversation too, is it just hopefully illustrates that you kind of have to have a number of people seated at the table to kind of help you. Your like I say, kitchen cabinet of advisors, your board of advisors, trusted advisors.
We're board of their directors.
Board of directors, essentially. Yeah. For both your personal, I mean, it's so challenging, especially for those with businesses, but I mean, for everybody, right? I mean, you kind of have all these intersecting circles, kind of almost like a Venn diagram of, you pull on one and then, you have another thing that pops up over here. So maybe my closing thought would be maybe going back to even that slide. I had kind of like 3 strategies to consider, around, assessing your situation, look at things, generally speaking, when tax rates are going up, your deductions are worth more in a high rate environment. So, it kind of flips the traditional tax planning on its head. So if you think tax rates are going up, then you may not want to accelerate deductions and pull them into 2021. You may want to save them for next year when they're worth more. But definitely looking at that. I've had a lot of conversations, definitely around the estate planning, as we've already talked about, but also the philanthropic giving. There's an added, I'll say kicker, I guess, in 2021, where effectively you could elect to give away 100% of your income and deduct all of it and pay no tax. To certain places, and it has to be cash contributions. But, again, it cuts the other way. If you think tax rates are going up, maybe those charitable contribution deductions are worth more in 2022 than they are in 2021. But you get the nature and the essence of all this, right? Is there's just a lot. All right, maybe I'll put one last closing thought here. Steve, you made a really great point earlier. Like, they didn't make this easier. It's getting harder. And that's already the commentary that I've heard about the proposals that are out there. The 2017 tax reform, it certainly added a lot of complexity. It made doing your tax return, as a guy that does tax returns, I can tell you this, it made doing your tax return harder. And some of the things that are included in here would certainly make both business and individual tax returns even more complicated. So complicated or something, I don't know. You get the point.
My
right?
last closing thought that not only is it going to be a more complicated world, the additional cash crunch is a huge issue. I mean, I'm sure you obviously looked at the numbers. If you put a capital gains tax, most of these guys have depreciated their businesses down to the ground, or their equipment, particularly. So when we're talking fair market value down the road, that's a whole nother ballgame. Otherwise, these guys aren't going to have big cost bases.
Yeah.
And there's going to be probably 80-90% of their company may be taxed on capital gains if they've taken accelerated.
I think the main thing there is that if you have transactions that you're contemplating, you need to be visiting with your advisors, your attorneys, people at Summit, people at BKD. As we wrap up, I think we're down to just a couple of minutes. I want to thank Damian and Bo for their presentations, and Jill for helping put this together.
Thank you. Well, we appreciate everyone on the call. And if you have any questions, you can send those over to marketing. So I'm going to send this to Riley, and we appreciate everyone attending today. Thank you.
Thank you very much.
I'd like to thank Damian Martin, Steve Holden, Bo Cotton, and Jill Young for their time and sharing this timely and valuable information with us today. And we would like to thank all of you for joining us on today's session. Please sure to follow us on social media. If you have any questions from today's session, if you would like a copy of today's presentation, or if you would like to be connected to a resource from either Summit or BKD, please contact us via email at marketing@yoursummit.com. For now, thank you for joining us and have a great rest of your day, and we'll see you next time.
I'm gonna take it out.
That was